Dr. J. You're going to be hearing from Mr. Top Step in a second. Mr. Top Step is called Top Step because the very top ring of that pit, that's where the biggest traders stand. You want to know what they're doing, you got to watch Mr. Top Step.
From the CME Group, this is Danny Riley in the S&P 500. We're up at about $1.30 in the S&Ps. We're really not seeing much outright trade. When I say outright trade, that means when customers or locals in the pit buy or sell for themselves. What's going on is we're in the rollover now. So when you take out these volumes out of the spreads or out of the outrights and you subtract that, you come up with really small volumes. In fact, yesterday, after we took out the spreads out of the big contract and the S&P, total volume was only around 10,000 contracts. When you took out the spreads and the Globex volumes and the minis from yesterday, they came in around about 1.5 million, which is a little lower than average. Right now, it's all about the spreads. We're into the rollover now, and what it is, what traders believe is during the rollover that they think it's harder to trade the S&P because the prop traders and the bank traders are concentrating on rolling positions, not adding positions. Tomorrow is going to be when the March becomes front month. That's when the Dece and the March will switch. Now, in a minute or two, we're going to bring on Larry Fabian from Vision Financial Markets. He's a professional in what he does over in the Eurodollar and Eurodollar options. Going forward, we're going to try to bring in more people throughout the CME Group and kind of explain what they do. Next week, we're going to try to hit the 10-year note options, and we're going to be moving around the floor, try to bring in more people up to snuff to what we're doing here on the trading floor. Larry's coming up right now.
This is Larry Fabian. Hi, I'm the Managing Director for Vision Financial Markets in the interest rate quadrant. I specialize in Eurodollar options. Today our volume is about 170,000 contracts. One-day basis point volatilities ranging anywhere from in the front months from 2 basis points all the way out through the reds, which is the 8th contract, furthest deferred around 9 basis points. Volatility has been coming in anticipation of the Fed's decision on Wednesday, I believe December 14th. We're expecting the Fed, as the whole market is, to remain pretty much unchanged. A lot of people have been positioning when the market broke last Friday after the unemployment number came out. It was a great opportunity for buying, and a lot of things took place. In the front month contracts, for example, we were buying the June 99 62.5 call and selling the SEP 99 62.5 99.75 call spread. We financed the trade. We paid 2 ticks. We're looking for the market to inch its way up. We're not looking for any change whatsoever on what the Fed's been talking about. Yes. We got an early gift from the Labor Department on Friday last week. Payrolls were only down 11,000. They revised down the 2 prior months. So at this point, when the market broke on the good news, expecting the Fed to make some kind of a move, that was a great time for us to step in and buy the market.